A very good morning. My name is IRFANA THASNEEM. I am working as an assistant professor in the Department of Commerce at AJK College of Arts and Science. In this video, we are going to learn about stock market, SEBI, stock exchanges, NSE, BSE, Nifty, Sensex, and OTCEI. We'll begin with the stock market. The stock market is where investors buy and sell shares of companies. The term stock market refers to several exchanges in which shares of publicly held companies are bought and sold. Such financial activities are conducted through formal exchanges and via over-the-counter marketplaces that operate under a defined set of regulations. Both stock market and stock exchange are often used interchangeably. Traders in the stock market buy or sell shares in one or more of the stock exchanges that are part of the overall stock market. The stock market allows buyers and sellers of securities to meet, interact, and transact. The markets allow for price discovery of shares of corporations and serve as a barometer for the overall economy. Buyers and sellers are assured of a fair price, high degree of liquidity, and transparency as market participants compete in the open market. A stock market is a regulated and controlled environment. Stock markets provide a secure and regulated environment where market participants can transact in shares and other eligible financial instruments with confidence, with zero to low operational risk, operating under the defined rules as stated by the regulator. The stock markets acts as both primary and secondary markets. As a primary market, the stock market allows companies to issue and sell the shares to the public for the first time through the process of an initial public offering. This activity helps companies raise necessary capital from investors. A company divides itself into several shares and sells some of those shares to the public at a price per share. To facilitate this process, a company needs a marketplace where these shares can be sold, and this is achieved by the stock market. Investors will own company shares in the expectation that the share value will rise or that they will receive dividend payments or both. The stock exchange acts as a facilitator for this capital raising process and receives a fee for its services from the company and its financial partners. Using the stock exchanges, investors can also buy and sell securities they already own in what is called the secondary market. So, in the primary market, the primary stock market provides an opportunity for issuers of stocks to raise capital to meet their investment requirements and to discharge liabilities. A company lists its shares in the primary market through an initial public offering or IPO. Through an IPO, a company sells its shares for the first time to the public. An IPO opens for a particular period. Within this window, investors can bid for the shares and buy them at the issue price announced by the company. Once the subscription period is over, the shares are allotted to the bidders. The companies are then called public because they have given out the shares to the common public. For this, companies need to pay a fee to the stock exchanges. They are also required to provide all important details of the company's financial information, such as quarterly or annual reports, balance sheets, and income statements, along with information on new projects or future objectives to the stock market. To speak about the secondary market, in a secondary market, the shares of a company are traded after being initially offered to the public in the primary market. So, after the transaction is done by an investor, the stockbroker issues him or her a contract note which provides details of the transaction, such as the time and date of the stock traded. Apart from the purchase price of a stock, an investor is also supposed to pay brokerage fees, stamp duty, and securities transaction tax. In the case of a sale transaction, these costs are reduced from the sale proceeds and then the remaining amount is paid to the investor. At the broker and stock exchange levels, there are multiple entities or parties involved in the communication chain, like the brokerage order department and exchange flow traders. Now, how is the pricing of shares done in the market? Demand and supply for a stock play an important role in the changes in the share prices as well as in determining the price of a share. Just keep this small concept in mind. When the demand for shares is more than supply, the price rises, and when the demand for the shares is less than the supply, the price falls. The Indian stock exchanges, BSE and NSE, have algorithms that determine the price of stocks based on the volume traded, and these prices change pretty fast. Now, what is SEBI? The SEBI stands for Securities and Exchange Board of India. It is a statutory regulatory board that was established by the Government of India in 1992 for protecting the interest of investors investing in securities along with regulating securities market. SEBI also regulates how the stock market and mutual function. Now, the SEBI, one of the most important objectives in setting up of SEBI is investor protection. It involves protecting the interest of investors by providing guidance and ensuring that the investment done is safe. SEBI prevents the fraudulent practices and malpractices which are related to trading regulation of the activities of the stock exchange. It develops a code of conduct for the financial intermediaries such as underwriters, brokers, etc. It maintains a balance between statutory regulations and self-regulation. For issuers, SEBI provides a marketplace that can be utilized for raising funds. For investors, it provides protection and supply of accurate information that is maintained on a regular basis. Finally, for intermediaries, it provides a competitive market for the intermediaries by arranging proper infrastructure. Now, SEBI board comprises of 9 members. One chairman of the board who is appointed by the central government of India, one board member who is appointed by the central bank, that is the RBI, 2 board members who are hailing from the Union Ministry of Finance, and 5 board members who are elected by the central government of India again. Now, the stock exchange in India serves as a market where financial instruments like stocks, bonds and commodities are traded. It is a platform where buyers and sellers come together to trade financial tools during specific hours of any business day while adhering to SEBI's well-defined guidelines. It is a wholesome market where securities of government, corporate companies, semi-government companies are bought and sold. It deals with second-hand securities associated with bonds, shares that have already been announced by the company previously. Stock exchange regulates trade in securities. The exchange does not sell and buy bonds and shares on its own account. The broker or exchange members do the trading on the company's behalf. Dealers are only in registered securities. Only listed securities recorded in the exchange office can be traded. Only through authorized brokers and members the transaction for securities can be made. Stock exchange required to be recognized by the central government. It acts as a measuring device by developing and indicating the growth and security of a business in the index of a stock exchange. And it operates as per rules. All the security dealings at the stock exchange are controlled by exchange rules and regulations and SEBI guidelines. Now, there are 2 major types of stock exchanges in India, namely the Bombay Stock Exchange and the National Stock Exchange. Now, the Bombay Stock Exchange was established in 1875 in Mumbai at Dalal Street. It is the oldest stock exchange in Asia and is the world's 10th largest stock exchange. The estimated market capitalization of Bombay Stock Exchange as of April stands at $4.9 trillion and has around 6,000 companies publicly listed under it. BSE revamped the country's financial infrastructure and has given a much needed boost to India's capital markets. BSE has also provided a platform for small and medium entrepreneurs to engage in equity trading. Over time, it has extended its offerings to include clearing, risk management, and settlement services. Now, to speak about the National Stock Exchange, it was established in 1992 in Mumbai and is accredited as the pioneer among the demutualized electronic stock exchange markets in India. This stock exchange market was established with the objective to eliminate the monopolistic impact of Bombay Stock Exchange in the Indian stock market. The estimated market capitalization of National Stock Exchange as of March 2016 was 4.1 trillion US dollars and was acclaimed as the 12th largest stock exchange in the world. Both these exchanges are popular among investors. Both allow stock trading. Besides equity, you can trade in bonds, mutual funds, and ETFs, commodities, derivatives, futures and options, and currencies on these exchanges. BSE and NSE are regulated by the Securities and Exchange Board of India. Both these exchanges have electronic trading facilities. The headquarters of NSE and BSE are both located in Mumbai. Over time, NSE beat the BSE to become the leading stock exchange in India due to several reasons like technology, like NSE's advantages. NSE's advanced and reliable technology infrastructure enabled faster and more efficient trading than BSE. NSE offered a more comprehensive range of financial products, including derivatives, which attracted more investors and traders. NSE strongly focused on transparency and disclosure, which instilled investor confidence and helped prevent fraudulent activities. NSE was known for higher liquidity levels, which meant more trading activity and higher trading volumes, making it easier for investors to buy and sell securities. NSE introduced several measures to increase efficiency, such as market-wide circuit breakers, which helped stabilize the market during the times of volatility. The Securities and Exchange Board of India introduced several measures favoring NSE, such as allowing it to launch new products without prior approval, which helped NSE grow faster than BSE. Both NSE and BSE offer trading opportunities in different types of securities. NSE, however, boasts of a large trading volume, making it easier for the price discovery mechanism to work effectively. This volume outweighs the limitation of the index containing only a few stocks and can allow better trading opportunities. However, some stocks are listed on the BSE only, so if you wish to invest in such stocks, you would have to trade on the BSE. You can compare the stocks across both these platforms and then choose one as per your requirements. Alternatively, you can opt for arbitrage trading and buy stock from NSE and sell it in BSE. Moreover, there would be a difference in the price of the same stock on NSE and BSE platforms depending on the stock's liquidity. Being a vital part of the Indian stock market, a stock exchange in India tends to influence the country's financial sector to a great extent. The collective performances happen to be deciding factor of economic growth. Also, all major types of stock exchanges are closely integrated with each other. If one major stock exchange falls, it will have a triple effect on all other major exchanges across the globe. For example, if the index of the Bombay Stock Exchange falls, its effect will be felt across stock exchanges like New York Stock Exchange, Tokyo Stock Exchange, Shanghai Stock Exchange as well. Now let's try to understand Nifty and Sensex. Now Nifty stands for National Stock Exchange 50 and is the equity benchmark index of the National Stock Exchange. Nifty is a stock market index used by the National Exchange of India to track benchmark performance of the companies listed on the NSE, including Nifty 50, Nifty Next 50 and other key indices. Under the brand Nifty, there are over 350 indices whose job is to read movements of the stock market using the weighted average and market capitalization of companies representing different sectors of the economy. Nifty 50 is the most referred index to track how the stock market is performing. Overall, Nifty indices are calculated using free float market capitalization method, helpful for benchmarking fund portfolios, launching of index funds, exchange traded funds, and other trading options. These 50 stocks account for nearly 65% of the total free float market capitalization of the index. Whereas the Sensex was launched on January 1, 1986. It is an investable index used to track the performance of India's 30 largest and most financially sound companies. These companies are listed on the BSE, previously known as the Bombay Stock Exchange, and represent some of the biggest and most important sectors of the Indian economy. As such, it is India's most tracked index. The Sensex is calculated in Indian rupees and US dollars. As of August 31, 2021, the mean total market capital of the index was 3.71 trillion rupees. Moving on to our next topic, Over-the-Counter Exchange of India, or the OTCEI. Now, OTCEI is an organization which was incorporated in 1990 under the Companies Act 1956. The trading in OTCEI commenced in 1992 and is a fully computerized, single window and transparent exchange. OTC market or over-the-counter can be defined as a place where sellers seek buyers and the buyers seek sellers, and then tries to arrange some terms and conditions for the sale and purchase which is acceptable to both parties. The two basic purposes behind the setting up of OTCEI are that it was set up for providing access to the capital market to small and medium companies so they can raise finance in a cost-effective manner, for providing the investors with a convenient, efficient and transparent avenue for capital market investment. Trading through over-the-counter does not take place from a specific geographical location. Instead, the trading procedure of OTC includes 3 steps. Go to an OTC over-the-counter, look for quotes on the computer screen. Lastly, make a sale or purchase if the price shown meets the target. Over-the-Counter Exchange of India is established on the lines of the National Association of Securities Dealers Automated Quotations, or we generally call it the NASDAQ. To summarize, the Over-the-Counter Exchange of India is an electronic stock exchange based in India that consists of small and medium-sized firms aiming to gain access to overseas capital markets, including electronic exchanges in the US such as the NASDAQ. There is no central place of exchange and all trading occurs through electronic networks. The OTCEI operates solely over a computer network. The exchange is recognized by India's Securities Contract Regulation Act, meaning all listed stocks on the OTCEI benefit equally as other listed securities on other exchanges in India. The exchange was established to provide investors and companies with an additional way to trade and issue securities. It arose primarily from small companies in India finding it difficult to raise capital through mainstream national stock exchanges because they could not fulfill the stringent requirements to be listed on them. The OTCEI has rules that are not as rigid as the national exchanges, allowing small companies to gain access to the capital they need to grow. The objective is that once they grow to a certain level and are able to meet the requirements to be listed on the national stock exchanges, they will make the switch over and leave the OTCEI behind. The OTCEI has some special features that make it a unique exchange in India as well as a growth catalyst for small to medium-sized companies. Now, the stocks that are listed on other exchanges will not be listed on the OTCEI, and conversely, stocks listed in the OTCEI will not be listed on other exchanges. The minimum capital requirements. The requirement for minimum issued equity capital is 30 lakh rupees, which is approximately only $40,000. Companies with issued equity capital of more than 25 crore rupees are not allowed to be listed. Members must maintain a base capital of 4 lakh rupees to continue to be listed on the exchange. Over-the-Counter Exchange of India has some listing requirements. The OTCEI makes it easier for small to mid-cap sized companies to be listed although there are still some requirements that companies must meet before being allowed to be listed. Stipulations include acquiring sponsorship from members of the OTCEI and having 2 market makers. In addition, once a company is listed, it cannot be delisted for at least 3 years, and a certain percentage of issued equity capital needs to be kept by promoters for a minimum of 3 years. This percentage is 20%. The transactions on the OTCEI revolve around the dealers. Dealers operate in a few capacities, the 2 most important being as a broker and a market maker. As a broker, the dealer transacts on behalf of the buyers and sellers. As a market maker, the dealer has to ensure the availability of the shares for transaction purposes as well as to ensure that the price remains reasonable through supply and demand levels. In addition to the dealers, OTCEI also has custodians. The custodian or settler is the individual that performs the multitude of administrative tasks necessary for the proper functioning of the OTCEI. These tasks include validating and storing documents as well as facilitating daily clearing transactions. Finally, the last group of players consists of the registrars and transfer agents who are responsible for making sure the correct transfer and allotment of shares take place. Now, the aim of India's over-the-counter exchange. OTCEI have few aims. Those are the faster availability for securities at a set fair price. It gives dealers simple, affordable ways to sell new issues in public. It ensures liquidity for the less liquid or the stock of smaller enterprises. It aims to give traders a straightforward purchasing and selling procedure. The Over-the-Counter Exchange of India and the National Stock Exchange of India are comparable and they share some characteristics. There is no trading floor for either of NSE or OTCEI. In other words, both exchanges use a computer network for their trading. Using computers and a satellite link, transactions on the NSE and OTCEI are carried out electronically. Entities that have been incorporated include the National Stock Exchange of India and the Over-the-Counter Exchange of India, which are both promoted by top banks, financial institutions, insurance providers, and other financial intermediaries. National reach is both National Stock Exchange and the OTCEI have a national reach. It indicates that neither the NSE of India nor the Over-the-Counter Exchange of India are restricted by geographic or physical distance. Both NSE and OTCEI offer traders a transparent market because all transactions are screen-based. Additionally, investors can verify the actual price of the securities at which the transaction occurred. Now, what separates the NSE and OTCEI? A major stock exchange in India that enables trading in securities of various kinds is the National Stock Exchange of India. Along with the futures and options section for other derivative instruments that the NSE introduced in 2000, a capital market segment was also introduced in 1994. The NSE is run by renowned experts and senior executives from the promoter institutions. It is funded by the top financial institutions, banks, insurance firms, and other financial intermediaries. These people exchange goods and services directly or indirectly. The trading members of the National Stock Exchange of India let investors buy and sell assets. Whereas OTCEI is a completely computerized single window and transparent exchange. Trading in OTCEI, OTC market, also known as over-the-counter, is a setting where buyers and sellers look for one another with the goal of coming to terms and conditions for the sale and purchase that are agreeable to both parties. OTCEI was created to give small and medium-sized businesses access to the capital market so that they could raise money efficiently and offer investors a convenient, effective, and transparent route for capital market investment. So that's about the basics of stock market in India, and thank you for listening. Thank you.